Hi everyone. Living in a time of rapid shifts in consumer behavior has significantly impacted many business operations. Today, I'm Andy and I'll be joined by Richard, Alwin, and Jing as we explore this phenomenon more deeply. One evident example is the shift from traditional streaming platforms to short form content apps like YouTube and TikTok, resulting in declining advertising revenues for major streaming platforms. In response, some companies took large write downs on assets, while media experts like Dan Barrett, on the other hand, suggested a strategic acquisition to stay competitive and regain relevance. Let's start with the impairment strategy. This technique is only possible when managers are given the flexibility to decide on when and how to impair assets. This is beneficial in several ways. Firstly, management can write down the value of underperforming assets to match its real earning potential. This prevents overstating the asset and ensure financial statements reflect current market conditions. Without this option, the company might have to continue amortizing over many years, misleading stakeholders about its true value. Second, it enables strategic decision making. As an example, if a company preparing to shift from traditional cable to digital streaming, many of its existing assets like old broadcasting infrastructure are no longer core to the future business model. By impairing those outdated assets, the company clears space both financially and operationally to realign priorities and reallocates resources into future focused investments. Lastly, it shows a responsible leadership. When a manager decides to acknowledge the loss from past investments with impairment, it shows that they are willing to acknowledge the mistake from past decisions and be accountable with that. This signals to stakeholders that the company is able to reset its course and will form a stronger foundation for long term recovery and strategy. While it does bring advantages, this flexibility can also be abused by some, leading to a manipulative trick like excessive big bath strategy. Now I'll pass to Richard.
Yep, thank you, Andy. Building on the Big Bath theme and its relevance to consolidated media groups, a clear example is News Corp's $931 million impairment in the third quarter of the 2020 financial year, tied to its former subsidiary Foxtel Group. The impairment stemmed from Foxtel's declining revenue and market shifting from long-form streaming bundles to short-form digital platforms. Foxtel's traditional model, including paid streaming bundles with long episodic shows, movies, and live sports, struggled to retain users who increasingly preferred short, algorithm-curated content. As a result, Foxtel saw sustained declines, including a 9% subscriber drop year on year between 2017 and 18, and over 2 years to 2020, lost 582,000 subscribers and 129 million USD in streaming and advertising revenue. Under AASB 136, this triggered an impairment test, which found Foxtel's recoverable amount to be below its carrying value. The resulting non-cash impairment slashed News Corp's goodwill and intangible assets, lowered total assets and equity, and contributed to a $1.55 billion net loss in the 2020 financial year, with earnings per share falling to negative $2.16 USD. However, in the 2021 financial year, the loss indirectly enabled a $64 million deferred tax asset via valuation adjustments under the GAAP system, which helped reduce News Corp's tax expense and contribute to boosting after-tax income to 389 million USD. The absence of impairments also improved optics for investors, specifically helping to lift EPS to 56 cents a share in 2021 and temporarily enhancing the return on assets and equity ratios due to temporary small asset base at the time. Strategically, the write-down paved the way for News Corp's 2024 sale of Foxtel for 3.4 billion Australian dollars, allowing it to recognize a larger gain on disposal through a smaller carrying amount. Overall, this big bath aided in resetting expectations, stabilized financials, and reframed an underperforming asset as a successful divestment opportunity. Now, here's Alwyn to discuss Apple's TV takeover of Warner Brothers.
Thank you, Richard. So moving on, there has been a speculation regarding the benefits of Apple TV Plus acquiring Warner Bros. Discovery, which owns HBO and other streaming platforms. So the accounting implications of this purchase depends on how much Apple TV Plus wants to acquire Warner Bros. Or simply Apple that wants to acquire Warner Bros. Because Apple TV Plus is not a separate legal entity but directly part of Apple Incorporated. So in the first scenario, we assume that Apple acquires 100% of Warner Bros. And in fact, Warner Bros. Owns 100% of HBO. And under this fully ownership structure, Apple will need to consolidate all of Warner Bros. And HBO's identifiable net assets at fair value. Then, Apple needs to identify whether they will recognize a goodwill or gain on bargain purchase. And in future years, Apple will need to adjust its group retained profits to include all post-acquisition earnings and fair value adjustment impacts, such as extra depreciation on revalued PPE, for instance. And in the acquisition year, Apple will eliminate its investment in Warner Bros. And in later years, Apple will remove intra-group transactions and unrealized profits. Next, in the second scenario, we assume that Apple acquires only 70% of Warner Bros. Instead of full ownership, which means there's now a NCI that holds the remaining 30%. And for the goodwill measurement, Apple can choose either under full goodwill method or under partial goodwill method. And NCI now needs to be recognized at acquisition, either at fair value if using full goodwill method or as 30% of net assets if using partial goodwill method. And for future years adjustments, only 70% of profits is added to the group retained earnings, and the remaining 30% is allocated to NCI. And now, the elimination entries need to reflect the NCI, such as by recognizing the NCI's 30% share of equity separately and allocate post-acquisition profits between Apple and NCI. And now, I'm gonna hand over to Jing to discuss the impact if streaming viewership keeps declining.
Thanks to Alvin's intro on how Apple might account for WBD acquisition. So let's think ahead. What happens if the industry keeps declining in 5 years? And very tough question, right? Because TV households have dropped 20% in 5 years. And if the trend continues, Apple's acquisition could become a hidden danger and counting time bump. So why a bump? Because the deal creates huge intangible assets. And what if WBD underperforms? First, HBO content and patent get amortized, and if few people watch it, their value drops. Second, the goodwill. Apple pays for the WBD's reputation and ASB 136 annual testing. If cash flow forecasts fall, impairment loss debit and accumulate impairment credit. So you may ask that, would this really happen? Just look at Disney. They bought Fox and then streaming wars and COVID hit it, and 1.45 billion of goodwill just vanished overnight. And Netflix crushed Hulu, and SEC stepped in. Some familiar, right? Because Apple have faced very similar risk. The high goodwill, streaming linked cash flows, but Apple's stronger reserves may observe the shock. So, how might Apple respond? Sell HBO to Netflix and turn assets into cash, and or use impairment tests as early warnings. Yes, IFRS allow Apple to reserve losses if WBD recovers. But let's be real, if users keep playing to TikTok in 5 years, those tests will bring bad news. Okay, that's the end of our presentation. Thank you for your listening.